Hi everybody, this is Corey Harrington, founder of Creative Real Estate Made Easy. I'm answering questions here from Yahoo and some from my students. Today I'm just going down the line. I only have a few more minutes to answer all these questions, but this question is starting in commercial real estate investing is the title of the question, and it says, what price range of commercial property can I realistically apply for a loan on if I make $70,000 a year and good credit but have less than $10,000 in liquid assets? Assuming I am able to come up with 20% down on a property, I have found plenty of promising properties for cash flow with cap rates around 13%. I just don't know what range is too high or too low. Okay, this is a loaded question. There are a lot of questions asked within this single question. First off, you want to get pre-qualified with a lender. You want to make sure that they're a commercial lender. I teach residential real estate investing, but my portfolio of properties is in commercial real estate as well. And I actually started in commercial real estate as an investor. I syndicated a few deals, I've done a few things, and I have a lot of training in commercial real estate. My family's in commercial real estate as well, and I've been around it since 1999. Okay, so that being said, the question is, can they apply for a loan? How much would they qualify if they earn $70,000 a year? Well, commercial properties they need to be self-supporting. There is a DCR, or a debt coverage ratio, that they want to factor in. The debt coverage ratio right now, depending on the type of commercial asset, will be ranging from 1.65. It could be 1.25. It just depends on the lender. The liquidity of the market at this point, the demand for that type of commercial space, and other factors, including yourself. So you're just part of a bigger picture when you're talking commercial real estate. The personal guarantee that you'll put on this thing is only as good as you have the ability to pay. So if you earn $70,000 a year, but you have $70,000 in debt per year that you have to pay monthly payments on, then you have no income at all as far as they're concerned. If the property itself is an existing dwelling, as he said, a 13 capitalization rate is a comparison of the value of the property to its sale price. So when you look at something with a 12 or 13 cap, more than likely they're Class B and Class C properties. Now, I can go through all these classes and all this stuff, but I'm assuming you know most of this straight out the gate because you're asking me a question about commercial real estate. So that being said, if you get a 13 cap and it's worthwhile, the debt coverage ratio would support it into the DCR ratio of, say it's 1.5, for example. You have actual rents there, a historical proof of rents, income, ledger. You have tax, taxes indicating how much the place had generated last year. There's rent rolls and all these things that will support the claim that the property is generating profit above the amount of money that you're proposing to borrow. You would have a sufficient DCR, and they would look less on your ability to repay and more on the ability of the asset itself to pay the debt. So hopefully that helps. In terms of having $10,000 in liquid assets, again, that comes back to how much you owe versus how much you earn. And those liquid assets, if you're getting into a commercial property, you might just dump that in a feasibility study alone. Feasibility study determines if the property's value is worth or is required, if that type of asset is required in that area. It's going to look at many different factors. I spent $8,000 on a feasibility study that I generated all the proof of. I went to CoStar. I signed up. I got a CoStar account, and I paid $500 a month for this thing. I did my own feasibility study, and they actually took everything that I provided and generated it within 2 or 3 days, came up with this thing and charged us $8,000. It was the same research I derived myself. The absorption rates were in line. It was appropriate for the area. There was a need for this particular asset in the area in terms of development, and that's what they're going to want to see. So if you have a high demand and a low supply of that particular type of asset, and you want to pick this thing up, and you're able to to put money down appropriate to where to where you can get the debt coverage ratio right, but you only have $10,000, you might eat that up just in the research alone. So you might want to look into that. If you have 20% down, again, this is wrapping back into the DCR. That was another question you asked. Cap rate, I want to know if the range is too high for me. Yes, I think I pretty much answered all your questions. So it's a pretty loaded question. You might want to call me directly and I can help you out with this. My office number is 210-682-8937 or 210-68-BUYER. I am a real estate trainer, coach, guru, whatever you want to call me, and I do take on students. So, these particular questions and more I can field for you as we go through our student program. So visit my website, www.creativerealestatemade.easy. Click on the link there. You can get some free material, which is tremendous value, as well as free coaching for a period of time. You can get to first session absolutely free and join my apprentice program, or you can just sign up for the thing I offer there. That's free of charge altogether. Hopefully this was helpful. Corey Harrington, thanks for asking the question.